U.S. stocks suffered one of their worst falls in more than 8 months today as shares of once high-flying technology stocks led a broad sell-off sparked by the recent jump in interest rate amongst many other things. The yield on the 10-year U.S. Treasury note is at its highest level in nearly 7 years, sending a wave of volatility into the equity markets. So is this the time to rejig your portfolio in light of the changing risk and reward profile? Joining me now is Brad Simpson. He is Chief Wealth Strategist at TD Wealth. What the heck happened today?
I guess you would call this almost like a turkey hangover, right? Like many long weekends across the globe. I don't know if you've, we spent an awful long kind of digesting a tough market at the end of last week. And then, if you perused a lot of newspapers on the weekend, kind of almost every story was along the lines of, well, boy, oil's a lot higher than what you thought it was going to be. Boy, interest rates are a lot higher than they were a year ago.
Yeah.
And you mix in worries about Chinese and U.S. currency and throw in almost a never-ending, almost a tariff announced every day. And I think we kind of open up and today the more and more the reality is that this is the discussion point in the market where I think there's a little bit of realization that maybe we're in a shift. And then, you start that shift and all of a sudden then the kind of the trade programs kick in and you start moving below technical averages where some sales just automatically are put in, and I think you get a market like you had today.
You talk a bit about, we were chatting before the show started about Jenga and all those little pieces you mentioned were almost like little blocks that were getting pulled out. Right. I know one thing that you mentioned too, and we've heard about, a report all day today is about yields obviously going higher, and if you start hearing things with, a four handle, it suddenly becomes, equities aren't the only game in town.
Right. No, I mean, look, you can get right now, you can get a yield on cash that is higher than the trailing dividend yield on the S&P 500. We haven't had that in a decade, right? And so first it was, well, the yield on the 10-year is higher, then it's the 2, now it's cash. And and then on the other side, you're starting to hear people talk about, gee, I went to renew my mortgage and somebody had a 4 when they were telling me about it. And that's a changing environment, and so what I think is quite amazing, and I think if you look at investment commentary, it's always when interest rates are going down, don't fight the Fed, don't fight the Fed, don't fight the Fed. Then interest rates start going up, and that just disappears, right? No one keeps saying don't fight the Fed, and maybe I know in our own portfolios we're not doing a lot of fighting the Fed, and so I think you have to really think about that. So. I think managing for interest rate risk is a big thing that you need to be doing in your portfolios. And today we saw the beginnings of this in the spring. And I think the bigger question, or maybe the more precise question is that when between January and March of this year, we had stock and bond markets correct, and then we just went quiet again. Yeah. And I think that kind of action we saw in the spring is more like we've seen today. And if anything, I think that's the pent up from, we just went quiet again. Yeah. And, the reality is that as central banks move away from this, we start getting into a market environment that's more real.
I know I let people know that we're about to talk a bit about your philosophy in general, the kind of things you think investors need to think about at this point because we've shifted. But one thing I know that you've written about is that when markets go down, one reason could be that we're heading towards a recession. Yeah. But you said based on kind of when you look at past recessions, and I think we have a chart we can bring up here, that doesn't look to be the case.
Sure. So there's two things that'll make a market go down, right? One is the known, and we're leading into a recession. So when we look at the recessions going back into the early 1970s and what are those kind of key inputs, we really don't have a check mark for any of those. So we kind of use this kind of thumbs up or a red thumbs down. But if we look right now, we do not have an inverted yield curve.
It's almost all thumbs up.
It's all thumbs up. The only one that we have really that we have moved is outlook for inflation, and we've kind of gone neutral there. Yeah. And that's kind of indicative of today. Is that part of the move is what if there's more inflation than what you think there's going to be, which will lead to higher interest rates than what you think they're going to, which again will have that can filter all the way through the economy. But today we are still not seeing that impact. We have a really healthy economy today.
All right, let me ask you, and I've only got about 30 seconds here, though. In terms of the shift that's going on, I know you're a big believer in kind of what got us to here may not get us to the next point. Right. So is that the spot we're in right now, though?
Well, I think every time we have a day like today, I think investors just need to kind of sit back and they need to think about, we are moving to a different environment, and this is just a changing of the signposts, right? It's just, as you know, like maybe you're in a little bit of the fork of the road, and you've chose one direction for a long time. It's time to think about a little bit different one. So to step back, look at your portfolio, and think about it in those terms. But also think about it in the terms that this changing of the guard doesn't mean it has to be going to a bad thing. It just means that we're going into a different thing, and let's make sure our portfolio is prepared for it.